let's bring in here one of Australia's most highly regarded economists, Chris Richardson, who joins me now. Chris, many thanks for your time. These numbers today, do they change really the economic landscape for the Reserve Bank in making its decisions?
No, I don't think they do. The two big things you've mentioned, the pace of growth and the increase in wages. Now, the pace of growth might have disappointed a few analysts, but it's pretty much in line with what the Reserve Bank has been thinking. And in essence, that says it is in the groove, slowing enough to take pressure off inflation, but not so slowing so much that job growth gives up. So the growth side of the equation, the Reserve Bank will be pretty happy with that. Wages, as you say, there's a bigger question mark there. Now, that figure includes the impact of more jobs. It includes the impact of higher superannuation charges. It includes, people getting promoted, people shifting jobs. But it does say the underlying strength of wages picking up. And it is what the Reserve Bank yesterday was talking about. It wants to avoid that wage price spiral. So far in Australia we have, but yes, wages are stirring.
All right, then there's the other aspect, is that this is for the September quarter. So this is before the government's industrial relations reforms have actually got through the parliament, which they have now, which the government and certainly senior ministers have said is deliberately targeted at raising people's wages. But as we've just discussed, there's already evidence there that maybe they were moving of their own accord because of the shortage of labour.
Yeah, and that backdrop, if you like, the lowest unemployment rate since 1974, has been the key to the wage pickup we've seen so far. Although there's been a lot of headlines about that industrial relations legislation, I don't think it notably moves the dial on wages. If you look at the official forecasts of Treasury and the Reserve Bank before, that legislation was even mooted, and after, it's not as though those forecasts have changed a lot. But it is the key forecast for the Reserve Bank now. What will wages do? They're happy that the economy is slowing enough, but will pressure stay off wages? Because if wages chase prices, chase wages, that means the Reserve Bank will keep swinging the baseball bat into 2023.
And unlike, say, the United States or New Zealand or the UK, you can see here the Reserve Bank is trying to get some sort of a soft landing for the Australian economy. In other words, economic growth might dip next year, but it's not likely to plunge into recession. That's the perfect scenario, the Goldilocks scenario that they could have. And it even is important for its own credibility now, having got previous interest rate forecasts so wrong, that they get these settings quite right. But they need the government to help them along the way.
They do. Now, that first point you made there, the international comparison is a good one. So far, inflation in Australia has risen less than in most other nations. Interest rates have risen less here as well, and growth has slowed by less. So there is pressure out there in the Australian economy, but relative to a bunch of others, we haven't seen the same degree of troubles. Now, part of that is because this global surge in inflation came at a time when Australia's wage system was not flexible. Keating and Kelty tried to make it more flexible years ago. Both sides of politics have poured concrete atop it. And so when the surge of inflation came, you haven't had an enormous change in wage growth here in Australia. It has, yes, it's moving up, but it has lagged what's been seen elsewhere. The other one, and again, you referred to it, what will the government do? What will that decision be around price caps? Most of the levers around inflation and therefore the impact on interest rates are outside the hands of the government. But they can do something around energy prices. That'll be something the Reserve Bank will be tracking pretty closely as well.
All right, now one of the biggest dominating factors in the economy right now, driving that economic growth, is the consumer. And you saw this with the household savings. The question I've often asked people is whether there is a brick wall in front of consumers sometime out in the new year, be it March or be it May or whatever it might be. And that is when really these interest rate rises and the energy price rises catch up with consumption and the savings start to run out. When that occurs, basically, if you have a drought of spending, that affects businesses, their profits, and affects the overall economy. We'll show people the household savings rate. You can see it coming down, can't you?
Absolutely, and that buffer, I mean, through the COVID crisis, basically we were given extra money, but we did not have the opportunity to spend it. So Australians ended up with more than $250 billion stashed in the financial system over and above what you would expect. We've been spending that down, not dramatically so far. It has eased the impact in Australia. But you are right. I mean, the continuing growth of the Australian economy in 2023 will depend massively on the consumer. Consumers are going to get that lagged impact from interest rate increases. There is a lot of pain there. Even with a degree of government intervention, electricity prices will still climb. That pressure on the purchasing power of consumers will have an impact. It's why most forecasters, including myself, expect the economy to slow down steadily through the course of 23.
I've got 10 seconds. Where's the peak in the Reserve Bank's cash rate now, Chris?
Look, I hope it's only one more increase early next year.
Chris Richardson, always good to have you in the program. Many thanks for your time.
Thanks, Ross.